Assalamualaikum warahmatullahi wabarakatuh. So right now I'm going to explain what is credit derivatives. Credit derivatives are financial contracts that allow one party to transfer the risk of borrower default to another party without selling the actual loan or bond. Think of it like insurance. The lender keeps the asset but shifts the risk. Credit derivatives are widely used for risk management, portfolio diversification, and even speculation. They are typically traded over the counter or OTC, meaning privately between institutions. Common examples include credit default swaps, total return swaps, and credit linked notes, and also collateralized debt obligations. Each of these serves a different purpose, but they all revolve around one core idea, which is managing credit risk without changing ownership. Now, let's look at credit swaps. It is a specific type of credit derivative. The most common form is the credit default swap or CDS. In a CDS, the buyer of protection pays regular premiums to the seller. In return, the seller agrees to compensate the buyer if the borrower defaults. It's essentially an insurance contract against credit failure. Another form is the total return swap, where one party receives the total return of a credit asset, which including interest and capital gains, while paying a fixed or floating rate. Credit swaps are powerful tools for hedging, gaining exposure, or managing balance sheet risk. The key idea is the exchange. One party pays for protection, the other provides protection. Finally, we have credit options. Credit options are contracts where the payoff depends on credit-related events, like changes in credit spreads or actual defaults. One type is the credit spread option, which becomes valuable when the spread between risky and safe bonds widens beyond a certain point. Another is the credit default option, which pays out if a borrower defaults. Investors use credit options to hedge against deteriorating credit quality or to speculate on market movements. The payoff structure is similar to regular options. Nothing happens until a threshold is crossed, and then the value rises. Credit options are more advanced tools, but they offer flexible ways to manage or profit from credit risk.
So for credit linked note, structured investment product that combine a traditional bond with a credit derivative. They offer higher returns than normal bonds because investors are exposed to the credit risk of a reference entity. When an investor purchases a CLN, the issuers make regular coupon payments throughout the investment periods. If the reference entity does not default, the investor will receive the full principal amount at maturity. However, if a credit event such as default occurs, the investor may lose part of all of the principal invested. Therefore, CLNs are suitable for investors who are willing to accept higher risk in exchange for higher potential returns. Next is contract of difference CFDS, a derivative financial instrument where two parties agree to exchange the difference between the opening and closing price of an underlying asset. They allow traders to speculate on price movement without owning the actual assets. CFDs are characterized by several key features including high leverage, cash settlement, and the ability to profit from both rising and falling markets. Although CFDs offer the potential for high returns, they also involve a high level of risk. The use of leverage can significantly amplify losses and in some cases losses many as the initial investment. When market movements are in the trader favor, gains are realized. However, at price movement may result in settlable loss and margin calls. Therefore, CFD are generally unsuitable for risk-averse investors and are more appropriate for experienced traders with a higher risk tolerance.